Married couples routinely forfeit up to $300,000 in lifetime Social Security benefits. This massive loss results from suboptimal filing timing decisions. Your benefit calculation uses the highest 35 years of indexed earnings. Maximizing your lifetime payout requires coordinating two individual records. You must also account for potential spousal benefits. The primary goal is maximizing the higher earner's benefit. Use delayed retirement credits, or DRCs, to achieve this. A maximized benefit ensures the highest possible income stream. It also establishes the maximum survivor benefit for your spouse. Filing decisions must compare individual benefits versus spousal benefits. Spousal benefits equal 50% of the other spouse's primary insurance amount. The timing of the higher earner's claim is critical. It dictates the earliest date the lower earner can claim a spousal benefit. Coordinate these claims perfectly to capture the maximum dollars. The primary insurance amount is known as the PIA. PIA is the monthly benefit received at your full retirement age. Full retirement age, or FRA, varies based on your birth year. FRA currently ranges between age 66 and age 67. Filing before FRA results in a permanent benefit reduction. Claiming benefits at age 62 reduces the PIA by 25% to 30%. Delayed retirement credits are called DRCs. DRCs increase the PIA by 8% annually. These credits apply for every year claimed after your FRA. DRCs accrue automatically until you reach age 70. Delaying filing from FRA 67 to age 70 yields a 24% permanent increase. This increase is compounded monthly for life. Delaying the highest earner's claim is financially critical. This decision secures the largest possible future payment. A spouse is eligible for 50% of the other spouse's PIA. This benefit is only available if the other spouse has already filed for their own benefits. If the spouse files before their own FRA, the 50% spousal benefit is permanently reduced. The spousal benefit is only paid if it exceeds the individual's own earned benefit. The Social Security Administration uses the deemed filing rule. Deemed filing applies when an individual files for any benefit before FRA. They are automatically deemed to have filed for the highest available benefit. This rule prevents claiming only the spousal benefit early. It stops individuals from allowing their own individual benefit to grow via DRCs. This rule applies to those born after January 1, 1954. Understanding deemed filing is essential for modern claiming strategies. The highest lifetime payout requires maximizing the higher earner's benefit. This benefit amount directly determines the future survivor benefit. The higher earner must delay filing until age 70. This captures the maximum delayed retirement credits. The resulting benefit will be 124% to 132% of their PIA. The lower earner can file for their own reduced benefit as early as age 62. This provides necessary income during the delay period. The lower earner's benefit will automatically switch later. It switches to the higher spousal benefit once the higher earner files. This switch occurs only if the spousal amount is greater. The spousal benefit is 50% of the higher earner's PIA. This coordination maximizes the total household income over time. Individuals born before January 2, 1954 are exempt from current deemed filing rules. This exemption allows a powerful strategy. They can file a restricted application for spousal benefits at their FRA. The restricted applicant receives 50% of the other spouse's PIA. Crucially, their own individual benefit continues to accrue DRCs until age 70. This strategy requires the higher earner to have already filed for their own benefit. If the higher earner delays until age 70, this application cannot be used immediately. The restricted application is only possible after the higher earner files their claim. This specific strategy is completely unavailable to younger couples. It is a grandfathered loophole for older filers only. If the lower earner has a very low PIA, they should file for the spousal benefit quickly. This filing should occur as soon as the higher earner files their claim. The lower earner must be at least age 62 to file. Filing before the lower earner's FRA permanently reduces both components. This reduction affects both the individual and the spousal benefit. If the lower earner's PIA is substantial, they should also delay filing. Delaying until age 70 maximizes their own DRCs. This requires the couple to manage the income gap until age 70. Optimal timing depends on comparing the lower earner's PIA to 50% of the higher earner's PIA. If the lower earner's PIA exceeds 50% of the higher earner's PIA, no spousal benefit is ever paid. Upon the death of one spouse, the survivor receives the higher of the two benefits. The survivor benefit is 100% of the deceased spouse's benefit amount. This includes all delayed retirement credits accrued up to age 70. Maximizing the higher earner's benefit to age 70 is the most critical step. This action provides maximum long-term survivor protection. If the surviving spouse was receiving a reduced benefit, the survivor benefit replaces it. The reduced amount is replaced with the full deceased benefit. The survivor benefit is available as early as age 60. However, it is permanently reduced if claimed before the survivor's FRA. Social Security benefits become partially taxable above specific income thresholds. Combined income determines this tax liability. Combined income includes adjusted gross income and tax-exempt interest. It also includes 50% of your Social Security benefits. For married couples filing jointly, benefits are taxable if combined income exceeds $32,000. Up to 85% of Social Security benefits can be subject to federal income tax. If you file before FRA and are still working, benefits are reduced. Benefits are reduced by $1 for every $2 earned above the annual limit. The annual limit was $22,320 in the year 2024. Once full retirement age is reached, there is no earnings limit restriction. This applies regardless of your current employment status.